Back in 2000, Enron wasn't just a company, it was an icon. But its collapse, well, it wasn't a simple market failure or just a string of bad luck. It was a failure of comprehension. This is the story of how a company weaponized complexity, turning confusion into profit, and ultimately creating one of the biggest frauds in history. So, let's break it down.
At its absolute peak, this was Enron's identity. Fortune magazine, pretty much the Bible of American business, gave them this title. We're not talking about Apple or some little startup called Google. We're talking about Enron. They were seen as the absolute pinnacle of the new economy. And get this, it wasn't a one-time fluke. For 6 straight years, they won that award. Just imagine that kind of praise. For pretty much the entire second half of the 90s, everyone agreed these guys were the undisputed champions of innovation.
To really wrap your head around the scale of this empire, just look at the revenue. In the year 2000 alone, they reported revenues over $100 billion. That made them the 7th largest company in America. The numbers were just staggering, and they seemed to justify all the hype.
And Wall Street? They bought in completely. The stock price just soared to a peak of $90 a share. Analysts couldn't praise them enough. Business schools were writing case studies on them, and their executives were treated like absolute rock stars. They had built this unshakable empire of success.
And then, just like that, in the span of a single year, it was all gone. From the peak of innovation to the largest bankruptcy the U.S. had ever seen. The key here isn't that they were outcompeted. No, they collapsed because the business model itself had become so complex it was basically incomprehensible.
All right, let's start at the beginning. Enron's origin story is really key to understanding their identity. They started as probably the most boring company you can imagine, and then transformed into something Wall Street had literally never seen before.
So in their early days, Enron was just a pipeline company. Predictable, regulated, safe. But when the energy markets were deregulated in the 90s, their CEO saw this massive opportunity. He thought, why just move energy when you could trade it? So they pivoted hard, transforming from a simple utility into this revolutionary market maker, basically creating an energy trading desk that acted just like a Wall Street firm.
And what they traded, it just shows you the sheer level of abstraction they were playing with. It wasn't just electricity and natural gas. They were creating markets for things like internet bandwidth futures and even weather derivatives. Literally placing financial bets on future rainfall. This kind of sophistication just dazzled Wall Street. It was complex, it was brilliant, and, as it turns out, it was the perfect cover for what was really going on. Okay, but here we hit the central dilemma. To keep this perception of endless growth alive, Enron needed a new kind of math. And this is where they turned accounting from a tool for recording reality into a tool for creating it. And this just brilliantly shows the core deception. See, normal accounting is pretty simple. You get cash in the bank, you record it as revenue. Enron used something called mark-to-market accounting. This allowed them to, say, sign a 20-year deal, guess at its total future value, and then book all of that projected, hoped-for profit as real revenue today. They hadn't actually received a single dollar, but on paper, they were already fabulously rich. Now, here's the real kicker. Mark-to-market accounting was technically legal. The SEC had actually approved it. The real fraud wasn't the tool itself, it was how they used it. They weaponized its complexity. It was designed to be so confusing that no one could really question the wildly optimistic and often totally fictional profit projections they were booking. Complexity became their shield.
But booking imaginary profits creates a very, very real problem. What do you do with your actual losses? So to keep the illusion of endless growth going, Enron needed a place to hide all its failures. This led them to the next layer of the deception, hiding debt in plain sight.
They did this using something called a special purpose entity, or an SPE. Now, in theory, this is a legitimate financial tool. It's essentially a separate company you can create to move assets and liabilities off your main books. But for Enron, these SPEs had one purpose and one purpose only, to be a dumping ground for debt and all their bad deals.
The best way to think of it is like this. Enron was stuffing all of its trash under the bed, and then telling everyone its house was perfectly clean. They created hundreds of these SPEs with these bizarre names like Chuco, LJM, and, I am not kidding, the Raptors. All the debt, all the losses were funneled into these entities, making Enron's own balance sheet look pristine and incredibly healthy. But here was the fatal flaw, the circular logic bomb at the very heart of the scheme. These SPEs were often controlled by Enron's own executives. They were funded with Enron's own stock, and they were guaranteed by Enron itself. This means that if Enron's stock price ever started to fall, the SPEs would collapse, and all that hidden debt would come rushing right back onto Enron's books. The company's very survival depended entirely on its stock price staying artificially high. So this incredibly elaborate financial structure just begs the question, where were the watchdogs? Where were the auditors, the analysts? Well, the answer isn't really widespread mustache-twirling corruption. It's something much more subtle, perfectly aligned incentives for silence. The incentives to just look the other way were perfectly aligned for everybody. Executives were paid massive bonuses based on that soaring stock price. Wall Street analysts didn't dare issue a seller rating because they were afraid of losing access to the company. The big banks made millions in fees for helping structure these shady deals, and Enron's own auditor, Arthur Andersen, was earning huge revenues from them. Everybody suspected something was wrong, but nobody wanted to be the one to pull the thread, because the entire sweater was woven out of money.
But here's the thing about a system built on collective belief. It's incredibly fragile. It can withstand billions of dollars in hidden debt, but it cannot withstand one single simple question. And in 2001, that question was finally asked.
In March of 2001, a Fortune reporter named Bethany McLean published an article with a devastatingly simple question: how exactly does Enron make its money? She just couldn't figure it out. And that one simple question cracked the entire foundation. By August, the CEO, Jeff Skilling, had abruptly resigned. By October, the truth started to leak out, and by December, the company was bankrupt. The collapse was just shockingly fast.
The impact was nothing short of catastrophic. The stock went from over $90 a share to less than $1 in just a few months. Thousands of employees lost their jobs and their entire retirement savings, which were almost all invested in Enron stock. Meanwhile, the top executives had already cashed out hundreds of millions of dollars before the final crash.
So the crucial point to take away is this. Enron's true dark innovation wasn't in energy trading. It was the weaponization of complexity. They turned their own intelligence into insulation from hard questions. They used financial sophistication as camouflage for their fraud. And they wielded confusion as a tool of control over analysts, auditors, and even their own people.
You know, the single most important lesson from the whole Enron saga is really a timeless business principle. If your business model requires a PhD to understand, there's a very good chance there's no real, sustainable business there at all. Enron couldn't explain their business simply, because the complexity was the business. And this brings us to a final, provocative thought for any leader today. Enron protected its complexity because it was generating those short-term wins, but it was that very same complexity that made the company hollow and ultimately destroyed it. So the question I want to leave you with is this. What part of your business are you protecting with jargon and complexity that might be preventing you from seeing the brutal truth? Let's talk about the hard pivots that are sometimes required in the comments.